Welcome back to Investing Talk Podcast.
Today we're looking at UiPath.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. What's really fascinating here is that UiPath seems to be in a clear re-acceleration phase.
Right.
And that's what's really underpinning the bullish long-term outlook.
Okay, let's unpack this then. What are the key data points that are actually showing this financial turnaround? Because, that's what investors want to see.
The most critical factor is the profitability inflection combined with, real growth acceleration.
Okay.
In the most recent reported quarter, that's Q3 FY26, revenue hit $411 million.
And that's a 16% year-over-year increase.
Right, exactly, which is a meaningful jump from, the low to mid single-digit growth they were seeing just a few quarters ago.
And what about the annual recurring revenue, the ARR? That's the really sticky part of the business.
That reached $1.782 billion, which is up 11% year over year. But crucially, the dollar-based net retention was 107%.
107%. So that's telling you existing customers are actually expanding their usage.
Yes. Even in a tough macro environment, they're spending more. That's a very strong signal.
And here's where it gets, for me, really interesting. Profitability. We've seen these growth companies just burn cash for years, but I'm seeing a mention of a GAAP profit milestone.
Exactly. Q3 FY26 marked the company's first GAAP profitable third quarter, $13 million in GAAP operating income.
$13 million. But wait, the non-GAAP number was $88 million?
It was.
That's a huge difference. Can you explain that? Because GAAP is the real number.
That is an excellent point. The GAAP there is almost entirely stock-based compensation, SBC. So because they pay employees so much in stock, it hits the GAAP number hard. But the fact that they're GAAP profitable despite that shows how strong the underlying cash flow really is.
I see. So it proved the business model is actually working at scale now.
It validates the whole model, yes. It shows some serious operational efficiency.
So what's driving that efficiency?
Management has signaled that an internal transformation, one focused on headcount discipline and sales and marketing efficiency, is now, quote, substantially completed.
Okay.
And that's leading to what they call significant operating leverage. You see it in the margins. General and administrative expenses are down, and gross margins are sitting around 83%.
83%. That's an incredible margin.
It is.
So if we connect this to the bigger picture, it suggests the business is maturing into a proper cash-generative SaaS platform. Do they have the balance sheet to sustain this?
Oh, absolutely. They enter this cycle with what you could call a fortress balance sheet, substantial cash, no meaningful long-term debt, a net cash position.
And they are generating free cash flow.
Positive. $174.5 million in net cash from operating activities in the 9 months ended October 31st, 2024. This de-risks the whole story significantly.
Okay, so the financial picture is strong. But technology is moving so fast. Their core business is robotic process automation, RPA. How are they staying competitive against giants like, say, Microsoft Power Automate?
Their moat, it really rests on two pillars. First is platform lock-in, and second is their pivot to what they're calling agentic automation.
Okay, hold on. Unpack that term for us, agentic automation. What does that mean in simple terms?
Think of it like this. Traditional RPA is like a recipe. It follows exact steps, and if one thing changes, it breaks.
Right.
Agentic automation is more like a smart employee. It can interpret data, make decisions, and coordinate tasks between robots and humans without a rigid script. It's a huge step up.
So it's moving from just automating repetitive tasks to automating entire outcomes.
Exactly. And that gets to their lock-in. They have over 10,000 customers. Once a company builds hundreds of automations on their platform, especially in critical areas like finance, the switching costs become incredibly high.
It's just too complex to rip all that out.
Too complex, too risky, too expensive.
So what's special about their AI stack? Is it just off-the-shelf stuff?
No, they have a unified platform approach. And their main advantage is their deep visibility into actual enterprise processes. All that data from their existing robots gives them a proprietary edge for training these new agents.
So they know where the real bottlenecks are inside a big company.
Precisely. They have the real-world data.
And what about the new agentic products? Is anything getting real-world traction?
The early metrics are very strong. They launched a product called Maestro, Think of it as an orchestrator or a traffic cop for AI agents, robots, and humans.
Okay.
It's already powered over 11,000 process instances just in the preview.
11,000, that's a lot of interest. And are people actually building with this?
It looks like it. They also have Agent Builder, which customers have used to create thousands of autonomous agents. Those have generated over 250,000 agent runs.
Wow.
And their AI assistant layer, Autopilot, saw engaged users jump 60% quarter over quarter.
So it's getting sticky. People are moving past the testing phase.
That's what the data suggests.
This brings up a big question, though. Who are they partnering with to build out this AI layer? You can't do it all yourself.
That's the key part of the strategy. They're partnering with everyone. OpenAI, Microsoft Azure AI Foundry, Google Cloud, NVIDIA, Snowflake, you name it.
So they're turning potential competitors, like Microsoft, into ecosystem allies.
Precisely. It lets them leverage the best foundational models right inside the UiPath platform, and it creates co-selling opportunities, especially with the big global system integrators like Deloitte.
Okay, so the fundamentals look solid. Profitability, cash flow, tech pivot. But the stock has been volatile. So what are the bear arguments? What are the risks investors need to be thinking about right now?
The immediate noise is coming from two places, mainly competition and governance concerns.
Let's start with competition. You hear concerns about Amazon or others bundling tools and crushing them on price.
That's a real risk for sure. The hyperscalers can always pressure pricing, but the mitigation is that UiPath focuses on the complex enterprise plumbing, the orchestration layer.
The stuff that big tech isn't as focused on.
Right. They're focused on a different part of the problem. They complement more than they compete directly with the foundational models.
And what about the governance issue? I saw some headlines about legal stuff and significant insider selling. Seeing the CEO sell shares always raises a red flag.
And that has been the biggest source of short-term pressure. It's contributed to dips of up to 9%. There are legal investigations, and the CEO, Daniel Dines, did sell over 135,000 shares.
That sounds pretty concerning. How should a long-term investor think about that?
It's all about context. Many of those sales were done under prearranged Rule 10b5-1 plans.
And for anyone who doesn't know, a 10b5-1 plan is what exactly?
It's a pre-scheduled trading plan. Insiders set it up months in advance to sell a certain number of shares at a certain time. It's designed to avoid any accusations of trading on non-public information.
So the headline says CEO sells, but the reality is he's just executing a plan he made 6 months ago.
Exactly. It's more about a preset schedule than a sudden loss of confidence, and he still retains substantial ownership.
So these headlines create, you could say, a sentiment dislocation, noise that distracts from the fundamentals.
That's a good way to put it. And for some investors, those dips driven by headlines can be attractive entry points.
Okay, so if the risks seem manageable, what are the near-term catalysts we should watch for over the next few months?
The biggest one is the Q4 FY26 earnings release. That's expected around February or March 2026.
And the guidance for that quarter is strong.
Very strong. Management expects revenue between 462 and 467 million, and non-GAAP operating income around 140 million. A beat there could lead to analyst revisions.
What about management signaling their own confidence? Any capital allocation moves?
Yes, they have an active share repurchase program, and they're using it. They bought back over 1 million shares recently at an average price of around $12.43.
So they're putting their money where their mouth is.
They are. It provides a nice buffer against downside volatility.
Any other catalyst? Maybe something not tied to earnings?
Yes, there's a market structure one. The stock is expected to join the S&P Midcap 400 index.
And that's important because
It mandates passive buying from index funds and generally increases institutional coverage. It just provides structural support for the price.
Okay. So to wrap this all up then.
So what really stands out here is a company that has executed a successful pivot. They've gone from a growth at all costs model to a cash-generative, profitable platform leader in this critical field of agentic automation.
And the convergence of that reaccelerated revenue, the profitability, and something like an index inclusion really sets up a constructive outlook.
It does, assuming they maintain that execution, especially in delivering on the promise of these new AI agents.
The long-term thesis is clearly tied to monetizing that agentic stack, turning those thousands of agent runs into real, sustained ARR growth. The key question now is whether this operational leverage is sustainable. It's a fantastic story right now. If you're interested in tracking this going further, make sure to hit that subscribe button to catch our next analysis.